Most of the people I know who have built real wealth look exactly like everyone else from the outside. They drive cars that have been paid off for years. They live in houses they bought when prices were lower and never traded up. Their watches don't make a statement. Their vacations are mostly visits to family. If you walked past them at the grocery store, you would not stop to think about how much money they have, because nothing about them tells you. And that's the entire point. The wealth building work happens in the background, through a specific set of moves that almost nobody talks about because they don't make good thumbnails. You don't see Instagram posts about increasing your HSA contribution by $200 a month. TikTok dances about the super catch-up contribution for 60-year-olds don't exist. But these moves are what actually build wealth, quietly, over decades, while everyone around you is busy showing off the wealth they don't have. This video walks through 15 specific moves, grouped into 5 categories of 3, that quietly build wealth while leaving your visible life completely unchanged. None of these are theoretical. All of them are things real people do. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people, instead of the kind that gets you to click on a thumbnail. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that's what you want, hit subscribe. Before I get into the moves, a quick note on what counts as a smart move in this video. Every one of these 15 is something you can do without anyone noticing. Your spouse will notice, your tax preparer will notice. Beyond that, the moves stay invisible to your coworkers, your friends, your social media, and the people whose opinion you might otherwise care about. The whole point is that wealth building should be a private project, not a performance. Category 1. Income optimization moves. The first 3 moves are about getting more dollars in the door without changing what you tell anyone about your finances. These are the levers with the highest dollar impact and the ones most people leave entirely unpulled. Move 1 is to negotiate hard when starting a new job. This is the single point in your career where you have the most leverage to set your base salary, because the employer wants to close the offer and has budget already approved. Most people accept the first offer because the asking feels uncomfortable. Per multiple studies on salary negotiation, candidates who negotiate their initial offer receive an average increase of 5 to 10% over what was first offered, with no measurable negative effect on hiring outcomes. Over a 30-year career, a single $5,000 base salary increase at age 35, assuming standard 3% annual raises on top, compounds into roughly $238,000 of additional lifetime earnings. Nobody sees the negotiation. Nobody knows you did it. The money just shows up in your paychecks for the next 3 decades. Move 2 is to switch jobs every 3 to 5 years for the wage premium. Per Bureau of Labor Statistics data on wage growth among job changers compared to stayers, employees who switch jobs typically see wage premiums of 5 to 10% above what those who stay receive. Over a 30-year career, that compounds into a meaningful base salary difference. The person who switches 3 times between age 30 and 50, with a 7% premium each time on top of normal raises, ends up earning roughly 25% more by 50 than the person who stayed in one role the whole time. Loyalty to a single employer is one of the most expensive habits in modern personal finance. The move is invisible because nobody at your new job knows what you used to make. Move 3 is to take every dollar of available employer match before any other voluntary saving. This sounds obvious, but per Vanguard's most recent How America Saves report, only about 14% of employees at firms offering 401k plans contribute the maximum allowed, and a meaningful share don't even contribute enough to capture the full match. The average employer match is between 4 and 6% of salary, with the most common structure being 50 cents on the dollar up to 6% of pay. For a $100,000 earner, that's a guaranteed $3,000 a year of additional retirement income on top of their contribution, which works out to about $285,000 of additional retirement balance over 30 years at a 7% real return. Leaving any of that on the table is the most expensive, invisible mistake in personal finance. Category 2. Spending architecture moves. The next 3 moves are about making one-time decisions that quietly produce wealth-building margin for the entire decade that follows. These are the moves that don't show up on a budget worksheet because they're about the structure of your spending, not the line items. Move 4 is to buy a 2 to 3 year old used car instead of a new one. Per Edmunds Q4 2025 data on average car payments, new car buyers were paying about $772 a month, while used car buyers were paying about $537 a month. That's a difference of $235 a month, or $2,820 a year for the entire ownership period of the car. Over a typical 6-year ownership period, that's nearly $17,000 of additional cash flow, before counting differences in insurance premiums and depreciation losses. The car looks fine. Nobody at work notices the difference between a 2023 model and a 2026 model in the parking lot. The math difference shows up in your portfolio statement instead of your dashboard. Move 5 is to buy a house based on the 28% rule, not the maximum your lender will approve. The traditional 28% rule says that principal, interest, taxes, and insurance combined should stay under 28% of gross monthly income. Lenders, working off a separate back-end debt-to-income standard, will often pre-approve borrowers for housing costs that push closer to the 36% range. The difference between buying conservatively at 28% and stretching to that maximum approval for an $80,000 earner is roughly $530 a month in lower fixed cost, or $6,400 a year. Over a 10-year ownership period, that's $64,000 of additional savings capacity invested over time, which compounds to roughly $90,000 of additional wealth at a 7% real return. The smaller house looks fine to everyone except your real estate agent. Move 6 is to do a quarterly subscription audit. Most households accumulate $150 to $300 a month in subscriptions they no longer use or barely use, often because the charge is small enough to evade the household monthly attention threshold. The audit takes about an hour, 4 times a year. The pattern I recommend is to pull up your credit card statements from the last 3 months, identify every recurring charge, and ask whether each one provided proportional value during that quarter. Most households eliminate $50 to $100 a month on the first audit, which translates to $600 to $1,200 a year of recovered savings capacity with no lifestyle change anyone outside your house can detect. Category 3. Tax efficiency moves. The third set of moves is about routing your money through the right accounts so that less of it ends up paying tax. The IRS has built specific pathways into the tax code that reduce your lifetime tax burden, and most people use only a fraction of what's available. Move 7 is to use your HSA as a stealth retirement account if you have a high deductible health plan. The health savings account has what's commonly called the triple tax advantage. Contributions are tax deductible, growth is tax-free, and qualified withdrawals are tax-free. The 2026 contribution limits are $4,400 for individual coverage and $8,750 for family coverage, with an extra $1,000 catch-up for those 55 and older. The stealth move is to pay current medical expenses out of pocket while you can afford to. Let the HSA balance grow invested for decades, and use it for medical expenses in retirement when healthcare becomes a major budget item. A family maxing the HSA at $8,750 a year for 20 years at 7% real return ends up with roughly $360,000 of completely tax-free medical reserves. Nobody outside your household knows you have it. Move 8 is to claim the 2026 Super Catch-Up contribution if you're between 60 and 63 years old. This is a Secure 2.0 Act change that most people don't even know exists. For 2026, employees aged 60, 61, 62, and 63 can contribute up to $11,250 in additional catch-up contributions to their 401k, on top of the standard $24,500 contribution limit. That's a total of $35,750 in tax-advantaged retirement contributions in a single year, available only during a 4-year window. 4 years of maxing the Super Catch-Up adds $45,000 of additional pre-tax contributions during that window that wouldn't otherwise be available. At a 7% real return, that $45,000 grows to roughly $61,000 by age 67, even though the contributions only had 3 to 7 years of growth. One 2026 wrinkle worth knowing. Under Secure 2.0, if your 2025 FICA wages from the same employer exceeded $150,000, your catch-up contributions in 2026 must be made as Roth, not pre-tax. The Super Catch-Up still works mathematically. The tax timing just shifts from pre-tax to Roth for high earners. Most plans require you to opt in, and most plan administrators don't proactively notify eligible employees. The move is invisible because almost nobody knows the rule exists. Move 9 is to stack the Roth IRA on top of the 401k. The 2026 Roth IRA limit is $7,500 for those under 50 and $8,600 for those 50 and over. The key insight is that this is a completely separate bucket from your 401k. A 401k contribution doesn't reduce your Roth IRA limit, and vice versa. Most people contribute to their 401k and stop there, assuming they've used their tax advantage space. They haven't. The Roth IRA bucket is sitting there, generating tax-free retirement income for decades, completely unused. For 2026, single filers can contribute the full amount with modified adjusted gross income under $153,000, with a phase-out range of $153,000 to $168,000, and no direct contribution allowed above that. For married couples filing jointly, the full contribution limit applies with Magi under $242,000, with a phase-out range of $242,000 to $252,000. For high earners above these limits, the backdoor Roth conversion accomplishes the same thing through a contribute then convert sequence. The opening of the account is a 30-minute administrative task. The 5-year payoff is measured in tens of thousands of dollars. Category 4, Investment Mechanics Moves. The fourth set of moves is about how the money actually grows once it's invested. These moves don't change what you're saving. They change what your savings does after you've saved it. Move 10 is to use broad market index funds with expense ratios under 0.10%. The S&P 500 index fund with a 0.03% expense ratio outperforms the actively managed mutual fund with a 0.7% expense ratio almost every time over almost any horizon longer than 10 years. Per the S&P SPIVA scorecard, over the 15-year period ending December 2024, not a single U.S. equity fund category had a majority of active managers beat the index. The fee difference of about 0.67% a year sounds small in isolation. Over a 30-year horizon on a $500,000 portfolio, it compounds into roughly $200,000 of additional balance for the low-cost investor compared to the high-cost one. Same growth assumptions, different fund choice. $200,000 difference. Move 11 is to tax loss harvest in your taxable accounts annually. When investments held in a taxable brokerage account have declined in value, selling them realizes a tax loss that can offset other capital gains and up to $3,000 a year of ordinary income. The proceeds can immediately be reinvested in a similar but not identical fund, Maintaining market exposure. Over a typical decade with normal market volatility, tax loss harvesting generates several $1,000s in cumulative tax savings for someone with a $500,000 taxable portfolio. The IRS effectively lets you bank market downturns as future tax credits, but only if you actively realize the losses rather than letting them sit unrecognized. Move 12 is to rebalance annually rather than reactively. Most portfolios drift over time because some asset classes grow faster than others. The discipline of rebalancing back to your target allocation once a year on the same calendar date automatically sells some of what has appreciated and buys some of what has lagged. Per various academic studies on rebalancing benefits, annual rebalancing typically adds 0.2 to 0.5% of additional annual return over decades, while also reducing portfolio risk. The mechanical version, performed once a year, regardless of how you feel about the markets, outperforms the version where you rebalance more frequently or based on intuition. Category 5. Behavioral default moves. The final 3 moves are about removing decisions from your monthly financial life so that wealth building happens automatically, regardless of how you're feeling about money in any given month. Move 13 is to set your savings rate as a percentage of gross income, not as whatever's left over after bills. Most households accidentally use the leftover model, where savings happens last and gets whatever the budget didn't consume that month. The pattern produces an unstable savings rate that drops in busy months and rises in quiet ones. The fix is to define your savings as a fixed percentage, say 20% of gross pay, automatically routed to investments before any of the money reaches your spending account. My neighbor David, who I've described on this channel before, runs exactly this system. 20% of every paycheck routes to investments automatically, and the remaining 80% he spends without tracking. His net worth is well into 7 figures despite not earning a high salary, because the automation removed willpower from the equation. Move 14 is to time your automatic transfer for the same day as your paycheck deposit. The behavioral research on this is unambiguous. Money that sits in a checking account for any meaningful period of time gets recategorized as available to spend by the brain, even if your intention was to save it. The fix is to set the automatic transfer to investment accounts for the exact same date as your direct deposit hits. If your paycheck arrives on the 15th, the transfer to your brokerage account happens on the 15th. The money never spends a night in the checking account where the spending psychology lives. This is the single highest leverage piece of financial automation available to most households. Move 15 is to run an annual financial review on the same calendar date every year. Pick a date that's easy to remember, like your birthday or January 1st, and use that day to review 3 things: your current net worth versus a year ago, your current savings rate versus a year ago, and any major financial decisions that need to be made in the coming 12 months. The review takes about an hour. The value is that it creates a consistent feedback loop on whether your financial life is moving in the right direction, without requiring you to think about money constantly the other 364 days of the year. Per behavioral finance research, the act of explicit annual review correlates strongly with long-term wealth-building outcomes, partly because it catches drift early, and partly because it removes the need for ongoing vigilance. 15 moves is too many to start at once. The pattern I recommend is to pick one move from each of the 5 categories that applies most to your current situation. Implement those 5 over the next 3 months, and then add more from each category over time. Trying to do all 15 at once almost never works because it overloads the cognitive bandwidth available for financial change. 5 at a time, sustained, works. The reason all 15 of these moves are invisible to the people around you is that wealth building, done right, mostly looks like nothing from the outside. The Roth IRA you opened doesn't change anything about your house or your car. The negotiation you did when you took your last job doesn't change anything about how you dress. The HSA you're maxing doesn't show up in your social media feed. My retired neighbor Paul, who I've talked about on this channel before, drives a dented 2003 Subaru Outback and lives in a paid-off house that looks like every other house on his block. He has a portfolio in the 7 figures. Nobody who passes his house knows that. The wealth is real. The visibility is intentional zero. The flip side is also true. The people who look the wealthiest on social media often aren't, because what you're seeing is the spending, not the wealth. The two are almost opposites. The visible spending is what consumes the wealth that would have been built if the spending hadn't happened. The invisible moves are what produce the wealth that the spending would have consumed. Those are two different financial lives, and the people who end up wealthy almost universally chose the second one without making any noise about it. Drop a comment with which of the 15 moves you're going to start with, or which one was the biggest surprise to you. I read every comment and I'll reply to as many as I can. And if you want me to walk through the exact order I'd implement these 15 moves in for someone in their 40s or 50s starting from scratch, the specific sequence over the next 12 months, hit subscribe because that's the next video. I'll see you in the next one.